হ্যাঁ সৌহার্দ্য শোনা যাচ্ছে? সৌহার্দ্য সৌহার্দ্য
শোনা যাচ্ছে, শোনা যাচ্ছে।
আচ্ছা আমি তাহলে ওদের বলছি হ্যাঁ সময়কে। সময় জয়েন করেছে। সময় শোনা যাচ্ছে? সময় মিউট। Within 5 minutes we'll start.
Shogatuda, please check your WhatsApp.
Yeah, I have seen. Just 5 minutes.
Shogatuda, could you please check your WhatsApp for once?
Yes,
I have
yes.
written you something.
Yes, I have seen Suman.
Okay.
Let's start it, Onik. Yes.
Yes, we can start now.
Okay. Good evening, our respected President Sir, our director sir, our principal sir, our HOD sir, our dean sir, and all faculty members of IM and UN family members, and our dear students. It is a great honor and pleasure for me to host a online session. Myself, Shogato Ghosh, Professor Anik Hajra, and Professor Shauhardo Nandi will conduct the entire session. The today's event will be on a brief introduction to financial research through technical analysis. The organized by IM Management Department in collaboration with CMT Association. The today's speaker of the event are Mr. Shumay Goswami and Mr. Joel Pinnaker. Shumay Goswami is completed his graduation in mechanical engineering from Jadavpur University, Calcutta. He has been associated with the financial service industry since 2007. He is an avid believer of the evidence-based technical analysis and run his own volatility breakout models in Nifty, stocks, Bitcoin, crude oil in the prop account on his farm. Shumay is also passionate the teacher of technical analysis and enjoys the sharing his knowledge with learning something new from everyone. And Mr. Joel Pinnaker, the run the India operation of CMT Association. He is spent over the 19 years across the education technology industries, including the commercial education, corporate training, K-12, and continuing professional education. He has led three the technical startups. Before this, Joel was the CEO of DJIA Learning Labs and Educational Technology, the social enterprise. He also built a Take A Classes Foundation, a Section 8 NGO into Indian first crowdfunding platform for school teachers. From 2010 to 2017, the Joel ran the Bloomberg education strategy across the Asia Pacific, supporting the top universities and business schools. Now, I request to Mr. Shumay Goswami to start his presentation.
Thank you, Shogotada. Good evening, everyone. Myself, Shumoy, and it's a great honor for me to have a chance to show you what we do every day, day in and day out. It's all about technical analysis. So, without much ado, let us start today's presentation. Today, we will be talking about an introduction to financial research through technical analysis. So, let us begin with a formal definition. What is technical analysis that we are all very excited about? What is it? We talk so much about technical analysis, fundamental analysis, but let us try to understand. It is a formal definition, right? First of all, let us understand that technical analysis in its
Sir,
base.
sorry to interrupt you, but can you please adjust your microphone a bit because it's a bit lower in your volume.
Okay, is it right now?
Yes, sir. Thank you so much.
Okay,
Thank you
fine,
so
fine,
much. Please
fine.
carry on.
Right, sorry, yeah. So technical analysis in its basic form is nothing but the study of prices. Not only prices, there are many other variables that are generated by the market. We will be talking about that later, but the basic variable is prices. And that prices must be coming from a freely traded security, freely traded market, right? Freely traded means there is a security. I can buy as many quantity as I want, provided there is liquidity. There is no binding on that. It is freely traded. And it will be solely driven by supply and demand that I am coming to later. So study of prices in a freely traded markets. What is the intention? The intention is to make profitable trading or investment decisions. Our idea is to try to predict. Not always we are successful in predicting correctly, but our try is to predict the direction of the market, and so that some profitable trading or investment outcomes we can achieve, right? So that is the formal definition of technical analysis, what we all do. Going forward, there are some fundamental assumptions of technical analysis, right? Now, these fundamental assumptions are very basic, and based on these principles, all other principles of technical analysis are derived, right? Now, I understand that not everyone will initially agree to these basic assumptions, but they are very sound, and they have stood the test of time. And there are some allegations, there are some dispute, and we will later address to those things. So here I am stating in unbiased words, what are the 5 basic assumptions of technical analysis. First, stock prices or any security prices, it be gold, crude oil, Nifty, whatever, any freely traded security, those are determined solely by the interaction of demand and supply. So these two things we give the greatest priority, demand and supply. Stock prices tend to move in trends. Now, there is some debate. Do stock prices really move in trends? We will try to address that later. Because sometimes there are trends, sometimes there is no trend. We are always in a dilemma. What is the trend as of now? So we will address it. But this is a very basic assumption that stock prices tend to move in trends. Shift in demand and supply cause reversal in trends. So if there is greater demand, then we will see uptrend. If there is greater supply, we will see there is downtrend. And if there is any shift between supply and demand, then trend changes. That is also the basic assumption. Shift in demand and supply can be detected on charts. So the charts are our best friend for a technical analysis, and our only intention when we are looking at the chart is to try to understand the trend and its reversal. So shift in demand and supply can be detected in charts. That is also a basic assumption. And the last assumption is that chart patterns tend to repeat themselves. Very important. What do we mean by that? That means whatever were the principles of technical analysis 50 years ago or 100 years ago, the same principle with some minor changes here and there, basically they apply even today. They will be applicable even 200 years from now. So these are universal. And why they keep repeating themselves, that we also address later. So these are the 5 basic assumptions of technical analysis. Now, let us move on to the components of technical analysis. What are the variables that we use? As I told you earlier, price is the biggest component. By the term price, we mean there is open, high, low, close, etc. Not for a particular day, but it could also be a particular week, particular month, or even particular hour, or even particular minute. So any time frame, for any extended time frame that is not instantaneous, there will be an open, high, low, and close. So that is price. That is the single most important variable for technical analysis. There is volume. Volume means number of stocks changing hands. Someone is buying, someone is selling, how many volume is taking place. Larger is the volume, more strong is the trend, like that. Time. Time is also a very strong variable. There are many time cycles possible in technical analysis, whereby we can try to predict the change of trend. There are Hurst cycles, there are Elliott wave cycles. All those take time very seriously. So time is another variable for technical analysis. Open interest. Open interest is only applicable for the futures market. Sometimes open interest, futures market are also referred to as F&O. Now, open interest means how many contracts are open in the market. Larger is the open interest, more vigorous could be the trend reversal, like that, right? Market breadth, these are all variables, right? Market breadth means how many stocks are rising, how many stocks are falling, right? There is some quantitative trading strategies can be worked out from that, from market breadth. many a times we see that overall market is not rising. Many stocks are actually declining, but Nifty is keeping on rising. The Sensex, the index is keeping on rising. So in such cases, we say that the health of the market is not right. And we can check the health of the market by looking at the market breadth, the number of issues rising versus declining. And apart from these, there are also many sentiment indicators. Sentiment indicators are also very important. What is the mood of the market, right? They are basically contrary indicators, means when the market is extremely bullish, that itself is a bearish signal. And how do we understand that the market is extremely bullish? We can check the put to call ratio, right? There are options, and the option market, from this option market, we get the data. The put to call ratio, volatility index, like larger is the volatility, more threatened is the trend, right? There is COT report. COT report comes from US Commitment of Traders report. I will not enter into much detail with this, but that is a great sentiment indicator. So these are the variables to which we as technical analysts look at. Now, coming to the building blocks. So first of all, we need to know how the charts are constructed. To the left, you can see formal candlestick charts. The green chart means, the green candle means the open is lower and the close is higher. The red candle means the open is higher and the close is lower. And equivalent bar chart and bar chart, right? So the candle and bars are actually the building blocks of chart. Many such candles for every day or every week creates a chart like this. You can see this is a typical chart, right? This is a weekly candlestick chart. And these kind of charts, we, the technical analysts, constantly look at, right? We try to understand what is the trend, whether the trend is likely to reverse or not. So in this weekly chart of Nifty, you can see a few moving averages. The blue and the red, they are moving averages. The blue is the shorter one, the red is the larger one. Many trading signals can be worked out from the slope of the moving averages, from the crossover of the moving averages, crossover between the moving average and the price itself. So many trading signals can be worked out. To the upper pane of the chart, you can see a momentum indicator. I'm not entering into the definition of all these things. I'm just giving you a brief idea what are the basic variables and what are the basic indicators and oscillators of technical analysis. So this momentum oscillator, volume, there is volume at the lower pane of the chart, moving averages, all these are variables. And this is how a typical chart looks like. But there is no point that typical charts should only be like candles or like bars. There are many other types of chart patterns. So charts are not limited to candles or bars. There are many other kind patterns. This particular example is a point and figure chart. Point and figure chart of Nifty. So it looks a bit odd, but it is also very informative. Many kind of trading signals can be worked out from this chart. So by no means you should think that bar chart and candlestick charts are the only chart patterns that we look at, right? Now, having come to this point, we will address two important things. With all the sophisticated tools, swanky indicators and software at disposal, complicated computations becoming very cheap over time, data being abundantly available, how far do all these really go for the analyst to be able to predict the market? If you ask me, can you consistently predict the market with all these swanky indicators and oscillators? So the answer is that market is still an enigma, and it is not possible to predict the turns consistently. Once or twice we all are right? Once or twice we can be right, but consistency is the key word here. Can we become right consistently? That is the question here. I think no. Nobody can be consistently correct. Nobody can be consistently predict the market every time. So the question is, if the markets cannot be predicted consistently, how is it ever possible to make money? How do technical analysts make money? The simple answer is, I'm quoting one of the greatest traders and investors in the world, George Soros, and he says that it's not whether you are right or wrong that's important, but how much money you make when you are right and how less you lose when you are wrong. So many a times you will be right, many a times you will be wrong, but if you win much when you are winning, and if you win less, and if you lose less when you are losing, then the game is won, right? So that is what we are all trying to do. It's all about risk management, right? So you make lots of mistakes in trading and investing, but you will still survive in the long run and make money, lots of money, if and only if you take your risk management very seriously. And that makes trading with technical analysis such a great fun, because risk management can be done excellently with technical analysis. In technical analysis, you will always know when a certain signal has gone wrong. Suppose you bought it at 100 and it is not rising from there. It is falling to 99, then 98, then 97. At certain point of time, the logic with which you bought is no more valid. So at that point, you should understand that your decision was wrong. So when it does go wrong, it's time to accept a small loss and preserve capital. This is the basic idea of risk management, right? You have to preserve your capital for a next trade. Certain signals will be profitable. The second part of risk management is not to be afraid of profit. And that is very important, because people not only are afraid of losses, they're also afraid of profits. It goes to psychological aspects, but I'm not entering into that. But yes, that is a very important factor, that people are also afraid of profits. So let us not be afraid of profit and let the profits grow larger. Now, telling this is easy, but practicing this is extremely difficult, because some of these profits, when you are seeing profit, but if you wait it for long term, then some of these profits will vanish. But few of those trades will bear the fruit of patience. This is the true essence of any successful business. You have to make many small bets. You have to cut your losses early. Let the profits run. And by that way, you will become net profitable in the long run. Being right every time in market prediction is neither possible nor necessary, right? So that is why risk management is so very important. Let us move on. While talking about technical analysis, I must say why it is such a great fun. There are some universal nature of technical analysis that never changes. What are the natures? Location. Technical analysis could be applied in New York, that is any stock that is trading in New York, any stock that is trading in Tokyo, in Moscow, in 1850, in 1950, in 2050, anytime, right? This is because price actions in financial markets is a reflection of human nature. And human nature, more specifically, their collective response to stressful situations, are pretty consistent and predictable. Human nature. Technical principles can also be applied to any freely traded entity, like stock indices, individual stocks, foreign exchange, precious metals like gold, silver, energies, cryptocurrencies like Bitcoin, like Ether. Later on, towards the end of the presentation, I will show you few application of technical analysis on Bitcoin. Agro products, right? Like whatever the agro products those are trading, like there is wheat, there is sugar, all these agro products, and also credit instruments like bonds, right? So technical analysis can be applied to any freely traded entity. And principles of technical analysis are applicable to any time frame. You can apply it on 1 hour chart, you can apply it on daily chart, hourly chart, weekly chart, monthly chart, on any time frame. The only point is that shorter term signals are vulnerable to more random noise. You should be able to accept there will be less accuracy in short term, and the accuracy will improve in larger term, in longer term. So let us move on. There are two different ways technical analysis is used. Two different ways. One is predictive technical analysis, the other is reactive technical analysis. Predictive technical analysis, those who practice that, they are trying to predict the future market movements. They generally sell their services to clients and hence they seek more publicity. But there is other way, which is called reactive technical analysis. Reactive technical analysis, I personally prefer this way because we believe that markets cannot be predicted in the long run consistently. So it is best to follow the trend, to identify the trend, and the assumption is that the trends will likely to continue. So react to market conditions by buying or selling, and they do not seek publicity, whatever, anyway. So because publicity harms their objectivity, right? So there are two ways technical analysis are used, predictive and reactive. What is the goal of technical analysis? What does a technical analyst try to achieve? So the primary objective of any technical analyst is to ascertain the trend of the prices in any particular time frame. What is the trend? The trend could be up, the trend could be down, or the trend could be choppy. There is no trend at all in either direction. The concept of time frame is very important in trend analysis because there could be different trends in different time frames. Suppose the weekly time frame is uptrend, but in daily time frame there is choppiness. In hourly chart, prices are coming down. So there are many time frames, and those many time frames can have different trends. But longer term trends are stronger and more reliable than short-term trends. And that has a very strong logic. Why I am saying so? Why I am saying that longer-term trends are more reliable, they are more robust than short-term trends. Here it is. Long-term trends are more robust than short-term trends. But why? Principles of technical analysis are founded on psychological behavior of the crowd. It is all about psychology, the psychology of greed and psychology of fear. Now, the thing is, it is very difficult to predict how an individual will behave in a situation out of his comfort zone, right? We cannot predict how an individual will behave in a given condition that is stressful, right? But it is quite predictable how a group of people or crowd behaves under excitement or under stress. We see their combined behavior as audience. We see the audience in sports, audience in theaters, or even crowd during riots. Crowds move in unison. They move together in one direction. Now, individuals find it psychologically comfortable to imitate the crowd behavior, right? But they rather, they do not try to apply their own rational thought and behave differently because that is a stressful condition, right? People prefer to imitate the crowd rather than applying own rational thought and behave differently. So that is why the thing is like this. Now, we are entering into a very important concept, and basically this is an argument that is like an allegation that is levied against technical analysis. The basic question is it possible to predict the future by examining the past. See, as technical analyst, we only have the charts. And charts are what? Charts are actually, it is our way of seeing how prices have behaved in the past, not how prices are likely to behave in the future. Looking at the past, we are trying to predict the future. Now, this is a fundamental question. Is it ever possible to do that? Can I predict the future by examining the past? If that is wrong, if that cannot be done, then there is no point in studying technical analysis, right? So it is very important to address this query. There are basically two allegations. One is random walk theory that says markets are random. Market keeps up going down and going up. So those movements are random. Nobody can predict that. There is another way of saying the same thing, which is called efficient market hypothesis, that says market is so efficient that nobody can earn additional return from the market. Whatever the index is giving you, you can take that. But apart from that, nobody can earn any additional alpha, right? So that is called efficient market hypothesis. So if we can address these two questions, then we understand why technical analysis has some edge. Let us proceed. First, we will take the random walk theory. Do markets really follow a random path? Let me tell you something about what is randomness. A random walk occurs when future steps cannot be predicted by observing the past steps. For example, flipping a coin produces a random walk. Each flip of the coin is an independent event. And looking at the past results, what was the past 5 occurrences? Suppose there is 5 heads. We got 5 heads in a row. Does it mean the 6th coin toss will be a tail? No, that is not the case. The 6th coin toss has also a 50% probability, right? So looking at the past results, heads or tails, future outcomes can never be predicted. So this is an example of perfect random outcome. If the stock prices followed a random walk, then future stock prices can never be predicted by observing the past price movements. I'm showing you 2 graphs. They are the distribution chart. To the left, you see an ideal normal distribution. And to the right, you are seeing the real life distribution. The real life distribution is very different from normal distribution. If stock prices were random, their returns would have been represented by a normal distribution. The difference between them is the fat tail to the right and to the left. What do I mean by fat tails? Fat tails in real return distribution implies that stock returns are not random. And why so? Because there is continuous unidirectional movements. Fat tail means return, which cannot be explained by the randomness of the market. We will see more about it. The real life, the chart to the right is actually a return distribution of General Electric, GE stock. The real historical returns do not perfectly match with normal distributions. The striking differences are fat tails in real life return distributions, which is called leptokurtic. Fat tails occur when one or more events cause stock prices to deviate extraordinarily from their mean returns. Here I want to give you a mathematical evidence against random walk. Probability of a one-day decline of 10% in stock index. What is the probability of one-day decline? In one day, stock index declines 10%. That probability is 1 in 1,000. Assuming there are 250 trading days in a year, that probability becomes once every 4 years. Now, random walk hypothesis says probability of 2 consecutive 10% decline. What is the probability that 2 consecutive days, there will be 10% decline each. Definitely it is 1 by 1000 multiplied by 1 by 1000. That makes it a million, 1 in a million. Let us take it one step further. What is the probability of 3 10% declines? So that turns out to be 1 by 1000 by 1 multiplied by 1 by 1000 multiplied by 1 by 1000. That is 1 in billion. So there is, if stock prices moved randomly, then there would have been 1 occurrences in 1 billion trading days that there are 3 consecutive declines of 10%, or there is a 30% decline in 3 days, right? So it comes out to be 2.8 million years. Statistically, a 30% drawdown in 3 days can be expected only once in 2.8 million years. Now, is it really the case? That is not the case. We are looking at the historical drawdowns of Dow Jones Industrial Average, right? Dow Jones Industrial Average has a very long history of its trading. We have that at our disposal. We can see that in October 1987, in 4 days, Dow Jones actually fell 30%, over 30%. That was the 1987 crash, the famous crash. Going back 100 years, in 1914, we got a 2-day decline of 28%, 29% like that, right? So from top to bottom, I have noted down the greatest declines, historical drawdowns of Dow Jones Industrial Average in a 2, 3, or 4-year period. So historically, these large back-to-back drawdowns have occurred. It is not that they have not occurred. Especially they have occurred in declines. That's why I am using the term drawdown. When sequential returns reach a critical mass, they begin to foretell future returns, and hence they are no longer random or independent. These are called periods of dependence or pockets of predictability. At this point, markets are no more unpredictable or random, because this is beyond the randomness. This is occurring many times in past 100 years, and the statistical probability was only once in 2.8 million years, right? These successive declines have occurred more often than what is statistically predicted. Hence, random walk hypothesis is rejected. So we have rejected the random walk hypothesis. We are now into the second hypothesis, the second allegation, that is efficient market hypothesis. Efficient market hypothesis proposes that markets are efficient, markets are very efficient to such an extent that it discounts all available information very quickly by price going to a new level. Whenever a new information comes, market goes and market discounts it very quickly, and there is no opportunity left for making profit. If there is any irregularity in price action, it is quickly adjusted back to true value by arbitration, leaving no opportunities for profits. Whatever profit is earned during trending phases is lost and lost. Whatever earning you are getting in trending phases, it will be lost and more in trendless phases. So ultimately you are making a loss. That is what the efficient market hypothesis is saying. So practicing technical or fundamental analysis is a futile attempt. I'm talking not only about technical analysis, but also fundamental analysis is of no use. So that is what efficient market hypothesis is saying. Remember that profits can be earned only in inefficient market. If the market is, that is true. If the market is very efficient, then no profits can be earned. We only need inefficient markets where there is some profit opportunity left. So the question is the market really that efficient to render all forms of analysis useless? What is the evidence? Ostensibly, the efficient market hypothesis appears logical because a large number of investors actually lose money in the market, and that is our common experience. Large number of traders lose money. And if efficient market hypothesis says that it is not possible to earn profit in the market, ostensibly, it appears to be correct. Only a handful traders or investors win in the long run. So most importantly, if EMH were correct, technical analysis and fundamental analysis would really be a waste of time. and we should stop studying them right now. So how can we refute the propositions of efficient market hypothesis? We go to behavioral finance. That is a new branch of technical analysis, and that explains why prices are not always efficient. Yes, market sometimes is extremely efficient, but not always. And when markets are not efficient, that is the time we can earn profit. The debate surrounding EMH, or efficient market hypothesis, has been put to rest thanks to behavioral finance, which is a branch of technical analysis. Behavioral finance deals with how investors receive and process information in a biased manner. So the behavioral finance actually says that the way investors receiving information and they're processing it in their mind is not flawless. That has a lot of biases. What kind of biases? We will now see, right? The debate surrounding EMH has been put to rest, which is thanks to behavioral finance. Okay. Now the details of behavioral finance is outside the realm of this small presentation. Only certain points are mentioned here. Investors make various kinds of mistakes. These mistakes are called cognitive dissonance. And these mistakes are made in receiving and processing information. For example, investors tend to show a strong loss aversion bias. What is loss aversion bias? Holding on to losing positions in the hope that they will be recovered, but that recovery never comes. So that is loss aversion bias, right? And they are also selling off their profitable positions too early in fear of missing all the profits, right? So those are all the biases. Over long periods of time, price finally finds its value, its true value, as all biases get rectified over time. Long-term trends emerge in the price that takes prices from one level, which is the incorrect one, to another level, which is the correct one, after discounting the new information. I will just give you two examples to cite what it is all about, how informations are interpreted in all the wrong manner. And these misinterpretations are stored in prices as a deformation. And when the deformation is rectified, trend emerges and prices go from one level to another. My idea is just to explain why trends should emerge, because if trend emerges, it cannot be an efficient market. In an efficient market, there cannot be any trend, because trends are equivalent to profit opportunity. I am taking a very lively example. I hope you will like it. And this ostensibly seems beyond the market, but it is actually not beyond the market. Suppose I'm assuming two new restaurants open in a locality. There are two new restaurants, both are open, newly opened in a locality. We call them restaurants 1 and restaurants 2. Now a customer arrives. He has no prior information about which restaurant serves better food. He does not know. No prior information is available. So which one should he go to? He does not have any information. So again, in absence of any prior information, he makes a random choice. And suppose he goes to any particular restaurant. Suppose he goes to restaurant 1. Now what happens? A second customer arrives. He is also faced with the same dilemma. Which restaurant is better, right? But now he has an additional information. He says that he sees that one of the restaurants has a patron. At least someone is eating there. The other restaurant is still empty. So there is a higher chance that he will also visit that restaurant 1, 2, right? He is going also to restaurant 1. Now more customers are coming. The 3rd, 4th, 5th customers are coming. They follow the same path to restaurant 1 because they see more people dining there, while the restaurant 2 is still empty and unexplored, right? So restaurant 1 is flourishing and restaurant 2 is going out of business. right? And it was perfectly possible that restaurant 2 served actually better food than restaurant 1. It was perfectly possible. So what I want to say is that this is an information cascade, right? This kind of information cascade is very common to stock pricing, or rather say stock mispricing. How does it occur? When large fund houses or gurus with big fan following recommend certain stocks, people just flock to buy them without much apprehension. If any overlooked by the fund house in their analysis, that is never reflected in price, causing a trend based on misinformation. So this trend is based on misinformation. This is one of the many reasons of market inefficiency, right? So that is how market inefficiencies cause trend. And if that is true, then there is chance for technical analysts to be able to identify the trend and make profit. And this is my second example, why trends appear, right? Now, Robert Shiller, he is a Nobel laureate in economy in the year 2013. Robert Shiller gives us an outstanding explanation from the perspective of behavioral finance on why trends occur in financial markets. Before we go to Shiller's explanation, let me introduce you to this man. His name is Charles Ponzi, right? We have heard the name Ponzi scheme so many times, but we may not be aware of what is the origin of this name, Charles Ponzi. So let me tell you, Charles Ponzi was a swindler and a con artist in America in 1920s. He was a fraud. He ran one of the greatest financial frauds in early 20th century in the United States. Ponzi promised his clients 50% return in 45 days by buying postal coupon in other countries and redeeming them in the United States, which is a sort of arbitrage operation. The most important thing is investors actually believed in his version of a business, and they give him a lot of money. He amassed $20 million by selling his story. In reality, not a single penny was invested, and Ponzi was paying the old investors from the new investors' money, right? So he was paying the old investors from new investors' money. The model crumbled when there was not sufficient new investors to pay the old ones. That is how all Ponzi schemes get busted. Just further details about Ponzi schemes. How do they work? In a Ponzi scheme, contributions of new investors are used to repay the old investors. This serves two purposes. One, the shabby business model gains credibility. And two, the story about a successful investment venture is spread by the initial investors. So money actually flows upward towards the top of the pyramid in a Ponzi scheme. Money actually goes to the promoter, right? Now, do not ever make the mistake of thinking that Ponzi schemes are the things of past, or Ponzi schemes do not occur in India. I'm showing you an example, a very recent example. Sharada and Rose Valley scams hogged limelight in Bengal in recent past. They were also examples of Ponzi scheme where investors were duped millions of their rupees, right? It proves that investors are irrational. That is very important to understand. Investors behave not rationally, but irrationally, as they tend to believe in absurd returns. Hence, financial ecosystem, which is market, is inefficient. It also proves that Ponzi schemes are not things of past. They occurred in the past and they will happen again in future. Now, you may be wondering why we are talking about scams and Ponzi schemes and all these things. So here is my answer. Robert Shiller argues that trends are sort of speculative bubbles. Trends are simply naturally occurring Ponzi schemes in the market. Quite startling, huh? Trends are naturally occurring Ponzi schemes in the market. Trends evolve by themselves. Now look at the similarities, right? What is the similarity between any trend and any Ponzi scheme? Trends evolve by themselves. They attract new investors. They mature. And when the supply of new buyers exhaust, trends simply collapse. The same imperfect human greed that responds to the call of a glossy Ponzi scheme is also responsible for trends. So that is the point. The similarities between Ponzi schemes and trends are so very strong that it is very difficult to refute. So the markets are actually inefficient, not efficient. At least as much efficient as we are thinking, it is not like that. So we have come to the last portion of our presentation. We will be talking about some real life examples, identifying trends and its reversal in technical analysis. We deal in charts, and you can see this is how charts look like. So the basic idea is to identify the trends. The chart to the right, you can see, is actually a very long-term chart. It is almost a 40-year chart. I have shown it a very compressed manner. Sustained directional movements posed by intermittent pullbacks. That is all about trends. Trends continue for a long time. And this is actually a bond yield for 36 years since 1945. I took this picture from Martin Prink's book. So this is how trends can be depicted. Trend lines can be drawn. I am showing you one simple example and real life market. And when we are talking about uptrends, we will be talking about higher tops and higher bottoms, especially higher bottoms. As you can see, if prices are making consecutive higher bottoms or troughs, it is an uptrend. And an uptrend is aborted when this series of higher troughs ends. Frequently, this occurs after a lower peak. So when after making a lower peak, the previous bottom or the previous trough is broken, we can safely say that this is the end of an uptrend. In the same manner, peak and trough analysis can tell us about the downtrend. Downtrend is characterized by a series of lower peaks. And when the series of lower peaks is ended, you can see to the right of the chart that there are three peaks and the last price is going above that. So at the right hand of the chart, we cannot say that the downtrend is effective. So this is an example of trend reversal. So this is a very simplistic form, but this is basic. And this is very strong. If we can identify these things, then trend identification is not that difficult, right? So I'm showing you just an example of, I was thinking, which example should I show? There are a lot of examples. I could show you crude oil, I could show you Nifty, but I prefer, why not do something new and let me show you how Bitcoin moved over past several months, because I have told earlier that technical analysis can be applicable to any freely traded stocks, any freely traded market, and Bitcoin is one such market. I'm not entering into the details of cryptocurrencies. Someone may be a great supporter of technical analysis, someone may of cryptocurrencies, but I'm just telling you how trends or reversal of trends can be identified in any freely traded market. So in February 2020, Bitcoin topped out, right? And you can see the candlestick charts, red and blue. The previous uptrend was clear in the series of higher troughs on daily chart of BTC USD. This is the Bitcoin in terms of USD. That's why it is called BTC USD. Once a bottom violation occurred, in third week of February, the magnitude of the fall could not have been predicted. We did not know how far Bitcoin will fall, but we could surely say that the uptrend is no more valid, and that's all we need to know, right? We do not need to predict the market. Okay, the uptrend is no more valid, so let's get out or short the market or whatever, but it is no more an uptrend. So that was the time to sell. Likewise, this is a downtrend reversal of Bitcoin. This was the infamous bear market of Bitcoin in 2018. In 2018, Bitcoin made a top of $20,000 and it came down as low as $4,000, right? So that was a huge crash or downtrend in Bitcoin. But that downtrend ended so very classically. It is a beautiful trend reversal signal. As you can see that the series of lower peaks ended in early January 2019 by prices going above the last lower peak. So that was the moment to buy. Now, this is how we basically try to predict the trend reversals of uptrend to downtrend and vice versa. And I showed you just one such example. So this was my basic presentation, and I hope you have enjoyed it. At least I enjoyed it very much. So right now I hand it over to Shougata.
Shubham, if you wish, you can continue to the last two slides as well.
You want me to continue?
Yeah, please go ahead.
Okay, fine.
No. Can I come in? I am Professor P.K. Banerjee of
Yeah.
IEM.
Yes, sir. Please do.
Yes, sir. Please carry on.
Could I come in, or I think Mr. Goswami would like to continue with his presentation?
No, sir. Please,
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 Mr.
sir.
Banerjee,
He
please,
is our
he is our
dean, sir. He is our dean, Professor P.K. Banerjee. Yes, sir. Please.
To begin with, Mr. Goswami, I must compliment you on an extremely lucid and very, very informative presentation.
Thank you, sir. Thank you.
I wish more of our students who are doing specialization in finance would have joined this seminar. But what I learned is that there was some classes going on even till 5:30 or more.
Okay.
Because of which perhaps some of them could not join. Anyway, it is their loss. But what you have presented today,
Sir, you are not actually audible.
I'm not audible.
Sir, now
Yes,
you are
sir,
audible.
now.
Now
Yes,
we can get you.
See, yeah, this is again an example of randomness.
Yeah.
Yeah. It's
Right.
like the random walk theory. In one moment you can be heard, other moment you may not be heard.
Right.
Yeah. So nonetheless, I think personally I found it very, very informative, and I would like to use some of the examples quoted by Mr. Goswami in my own class, because
Okay, great, sir. Thank you.
Investment analysis and portfolio management in this semester, and some of these ideas are excellent, absolutely excellent. Okay, so I will rather like that others who have been in the audience, they should ask questions. But personally, I once more like to compliment Mr. Goswami on an excellent presentation.
Okay. So, Shougata, should I continue further?
yes, yes.
Okay, fine. So, let me tell you that I am representing Chartered Market Technicians here, the CMT Association, which is the gold standard of technical analysis. In India, there are so many technical analysts out there. Everyone who looks at the charts can call themselves the technical analysts. There is no standard. We do not like that. There must be some standard, right? So CMT Association was founded in 1970s. And CMT Association was formed in 1970s, and it is a global organization. It has its branch across all the continents, and in India, we are very strong. It conducts a program, which is the Chartered Market Technicians program. And after that program, we have to do some research of our own and present it to the board. And finally, we are given the charter. The charter means a lot to us. It is recognized globally. We have to clear 3 exams to get the charter, which is level 1, level 2, and level 3. And anyone who is serious about technical analysis, wants to learn more about technical analysis, uh, mm, how new kind of analysis can be done, which is different from the conventional valuation based models, for that technical analysis is extremely helpful. Nowadays, it is a science. We are blending it with statistics, with mathematics, everything. Backtesting is most important here. Just because I'm thinking something will happen, it may happen or it may not happen, but what is the statistical evidence that there is a higher probability of it being happen, right? So we need to do back test, we need to learn coding, we need to learn statistics, and we have to find our age. What is an age? Age is simply finding a little probability, that probability of something being happening over another, right? So to find that age, we have to do these things. So in this program, we learn about statistics, we learn about market, we learn about charts, we learn about little bit of coding, everything. And after that, we get our designation. So that's about CMT Association. We are very proud members of CMT Association. And anybody who is serious about pursuing finance should give it a thought. CMT Association is going to conduct a summit October 10 and 11, which is going to be a global which is going to be basically a global summit, because from Europe and from US, we are getting to see a lot of finance professional and very eminent professionals, the ones whose books we read every now and then, ones whose books we have read since our childhood on finance, on technical analysis. They will be delivering their presentation. Absolutely delightful. I'm looking forward to it, and I will recommend anyone who is even slightly interested in markets to participate in this summit. You can go to our website, which is cmtassociation.org, and you can learn a lot more about CMT Association. That's it. Shogatoda.
Thank you, Suman. What a wonderful presentation you have done. Yes, Onik. Pass out to the Onik. Onik, you look at anyone want to ask any question, they can ask.
Yes, I guess our students, those whoever attended that, have got some valuable inputs. And now I will ask them if the students have any question, they're open to ask. They can put their questions in the chat box itself, or if possible, they can unmute themselves and ask. And I'll be following the chat box. If you have any queries, if you have any question to Mr. Shumai Goswami or to Mr. Joel Panikot, you can ask your questions. They will be answering, will be interpreting your questions. You can put your questions in the chat box itself. So if you have any question, please feel free to ask and communicate.
May I ask a question to Mr. Joel, please?
Sure, sir, but let's see.
Yeah, if the students have priority, if there are students who want to ask, they have priority.
Yes, for the time being, no question from their side, sir. I'm following the chat box. Please carry on with your questions, sir. It will be a pleasure.
Okay. My question to Mr. Joel is, in India, are there offices of the CMT in the principal cities, or you are operating from an overseas office?
Should I answer this question? Because I think Joel is not there.
Okay.
I'm answering this question. Huh?
Okay. Okay.
Yes, we have our office in Bombay, right? That is our main office. And we have our chapters, local chapters in all other cities, in Delhi, Kolkata, almost in all other cities in India. But our head office is situated in Mumbai.
Okay. So let us say there is a Calcutta chapter.
Yeah.
Now, to be eligible to be a member of this chapter, do you have to necessarily register with this body, or you can you should have passed some part of the certificates. What is the eligibility
Certification is certification is not required for being a member. You can, even if you are interested a bit by for technical analysis, then you are eligible, and we conduct many webinars on technical analysis, and you can easily participate in them. So certification comes later. That is not mandatory at all.
Okay. So is there a membership fee?
Yes, there is a membership fee.
Yeah. Could you tell us what is that?
The membership fee for the charter holders, I can tell you, but for non-members, I cannot tell you. The membership fees for charter holder is $325 per year. And
but what about students?
There will be definitely some some rebate for the students. And I think Joel is the right person to answer these questions on these things.
Because
there will be some rebate
yeah.
for students. Definitely, yes, there it is.
See, we would like to encourage our students to become members, but you'll appreciate, obviously, they cannot afford to pay a high fee. Because
yeah, I understand.
At this stage, so if it can be made something which is attractive for students to become member and participate, that would be excellent. It will also motivate them to go for registration, go for certification at a later date.
Absolutely, sir. What I told you is only applicable for the members, and for students there is a huge discount. Right now, I do not know that, but I will ask Joel to communicate with you regarding this. Shogotoda is there. Shogotoda can tell this. We will communicate through Shogotoda.
Yeah. See, what my idea is, I'm just doing loud thinking with you, Mr. Goswami.
Yeah.
Is that since you have a chapter in Kolkata,
right?
As a subset of the chapter, if you could think of a sub chapter of students, and in IEM will create a chapter, a sub chapter of students who can be a part of your Calcutta chapter.
Great. That will be great. That will be great.
So something like that. Something
yeah.
like that.
Yeah.
Yeah.
Yeah. We will definitely pick it up from there, sir. We will talk it through with Shogotoda and try to move it from there.
And the whole idea is that then we motivate our students in this sub chapter to participate and work with you work with the chapter members, also in organizing events and conferences and all, possibly even using these infrastructural facilities of IEM.
Yes,
absolutely. It can be worked out. It can be worked out.
Well, very valuable inputs, and students, we're still welcoming your questions. If you have any queries, you can feel free to communicate. You can put your questions in the chat box. We'll be reading them out, and if you have any query, you can please shoot your questions there about technical analysis or about stock market. If you have any queries, you can ask your questions here. We'll be able to answer your questions. Sir, for the sake of our students, I mean, they are in the third sem, and the new students are there in the first sem, so they are not yet done with the derivatives market so far, so they will not be having enough idea about the call market or the put market itself. So for their benefit, can you please suggest how to interpret about extreme bearish market or extreme bullish market, so that it becomes easier for them to interpret the scenario of the market? Or I mean, is there any suggestion from your side how to analyze the stock price movement on a day-to-day basis following a particular newspaper or anything? What will be the suggestion for them?
Right. If you want to analyze the market, then newspaper or television channels are the worst source, that I am telling you, right? So if you do not have to do something, then do not follow the stock market news or anything either from newspaper or channels. You have to do your own analysis, because they give you a bias, right? They create the sentiment. The media creates the sentiment, and we use media as a contrary indicator. When there is an extremely bullish opinion about the market, that is how markets are likely to reverse downside. When the market sentiment is extremely bearish, and you will see those bearish sentiments on newspaper and media or everywhere, that is where the market turns upside, right? So you have to do your own analysis. Being a technical analyst, I will say charts are my greatest friend. Charts are my best friend. So you have to look at the charts. You have to look a lot of charts. Basically, the charts of Nifty and Sensex, they are the basic indices. They are supposed to represent the market, although they do not actually represent the market, but that is a different story. They are supposed to represent the market. And there are myriads of technical analysis tools. Suppose there are trend lines, simple trend lines. You can draw the rising bottoms and join a trend line, right? When the rising bottoms break the trend line, that is the end of the uptrend. Or when the reverse occurs, the falling tops, you are joining the falling tops. When the falling tops are breaking above that downtrend line, so that will require slight practice, slight eyesight habituation, and everything will fall in place, right? You can start with basic technical analysis books. I can recommend a few books like Technical Analysis Explained by Martin Pring, like Trading for a Living by Alexander Elder. So these are excellent resources to learn about market, to analyze about technical analysis. See, technical analysis alone is not sufficient. You have to learn about money management, and you also have to learn about psychological aspects of traders and investors. So all these things you have to learn, and these books, the two books that I named right now, Martin Pring's Technical Analysis Explained and Alexander Elder's Trading for a Living, are excellent resources. These are, you can say, these are the Bibles of the traders.
Thank you so much, sir. I hope our students have noted the names of the books that you have suggested so far. And I guess we are already past our stipulated time slot. So it's over to you, Mr. Shogota Ghosh, if we can please carry on with the further proceedings of this beautiful session that we had.
Thank you, Onik. Okay, Shumai. Thank you for a
Thank you,
wonderful
Shogota. Thank you,
presentation. Okay, I hope we will meet you again.
Yeah, sure.
And thanks a lot.
Yeah.
Now we went our session, and without Shauhardo, without Onik, this event cannot be possible. Thank you, both of them. And now I leave the meetings, and
Sure.
we'll meet you again.
And there is a message from our student Rahi Mukherjee. She's saying that it has been a very nice session, and we'd like to have more sessions like this. So yes, we hope we could arrange some more sessions
Yes.
like this, so that it becomes beneficial for you to understand about the certain salient aspects of the stock market itself, and it becomes handy for you. So thank you all. Thanks for your patient hearing. Thank you so much. Thank you,
Thank
Mr.
you.
Shumay Goswami, sir.
Thank you.
It has been a great session so far. Thanks a lot.
And another thing is, without our HOD sir, they have given me the opportunity to arrange this
Absolutely.
wonderful organization like this. Thank you, sir. Thank you, Dean sir, once again. And now I
Yes.
close the session.
Thank you.
Okay.
Okay.
Okay. Bye.
Thank you so much.